Thanks, Riley.
So this is, like I said, we're doing the applications in global modern portfolio theory.
Can you
and
turn
this
off-
is our,
Turn off the front lights. And one more. You can turn them all off. Perfect.
and this is our recommendation. What we want to do is create an international portfolio fund where the assets under management will be $30 billion, and it'll have an 8% growth by maturity. To make money, we'll have 2%. We'll make 2% in active management fees and 15% in performance fees. The holding is going to last 2 to 3 years, profiting $600 million in active management fees and $2.4 billion in performance fees, equaling a total of $3 billion.
Okay, and then so looking at the international correlation structure, Cheryl and Resnick in the textbook talk about superior returns. You want to look at the correlations that have, the countries that have less correlation to hedge off risk in the portfolio. And so this is true because there's different factors in each country: economic, political, institutional, and psychological factors that affect the superior returns in each of the countries. So if you look at the countries that have low correlations amongst each other, you can help hedge off some risk in your portfolio. And then according to Solnick, as the portfolio holds more and more risky stocks, the risk sharply declines. So we've seen that in the graph that we've talked about, Professor Suzes talked about, where if you look at the Swiss stocks and the US stocks, as you invest more into the country, you will lower your risk down to systematic risk, which is non-diversifiable, which is amongst the macro factors that go into risk. Next slide again. So we've talked about this quite a lot. This is the modern portfolio. Here is the efficient frontier. So we have the point right there, the OIP, which is the optimal international portfolio, which shows on the y-axis we have the standard deviation, which is equated to risk, and then the y-axis is the mean return. So at the optimal international portfolio point, we see where we have the lowest amount of risk or the highest amount of return, and then we can also hop off of that point and go up and down off the capital allocation line to adjust to the client's needs, whether they would like a less riskier portfolio and be willing to take a little less return for that, or they would want to go into emerging markets and higher and raise their risk but also raise their return. And then this is also another example of gains from the optimal international portfolio selection. So it shows here we have the mean returns and the standard deviation, which is the risk for an international portfolio and a domestic portfolio. So if you use the Sharpe ratio, we can see that the measure is 10% higher, suggesting that the international portfolio would have more return per unit of risk than the domestic portfolio. And then when we're looking at international bond investments, we see that there's a substantial amount of exchange risk amongst these. So when we're looking at the bond markets, we would want to, in order to gain and control the risk, we would want to look into derivatives such as the currency forward contracts or swaps, and using these, we can hedge off some of that exchange risk and really hike up the returns. And it's actually been shown that international bond portfolios can actually outperform international stock portfolios if you can hedge the risk using the currency forward contracts or the swaps effectively.
This is a little bit on where you should maybe look to invest your money, how to diversify your portfolio, where to invest into. First is international mutual funds. And to diversify better than just going into a fund in a different country is to use US based, and that's to save transaction costs from going into another country and having to exchange your currency back when you're trying to make your money. To circumvent legal or institutional barriers that go into other countries, their legal setups, their policies on how money exchanges work and whatnot. And then the benefit of expertise of a fund manager, whoever you decide to go into. How these funds are valued is their liquidity is based on their NAV, which is their net asset value. which is at the end of each day. This net asset value is it's calculated to how much the mutual fund or how much your share is worth, and then based on where that mutual fund is investing their money into, you're going to have either premiums or discounts that are going to take away or add onto the value that you want to sell your share of mutual fund at. And mutual funds hedge the risk of domestic index fluctuations by having money in global markets, in the funds that are investing in global markets. The domestic fluctuation of the stock markets, fundamental news in the U.S. doesn't affect your portfolio as much. And one way that most people try to diversify is to use U.S. multinational corporations that have most of their profits and most of their cash flows in other companies or in other countries, but the problem is that they're still under the policy of U.S., they're still under our regulations, so any fundamental news in the U.S. is still going to highly affect those companies, which is why you want to go with a mutual fund rather than directly into multinational corporations. Going into country funds, you can diversify by going into single foreign markets. Again, it has minimum costs. You can go into, you can have multiple of these in your portfolio, use them as building blocks to have a wider range of a international portfolio overall. And on top of that, for more private investors, you can access emerging markets that you can't access by yourself. And these are also based on the NAV, which is the net asset value. And so again, like these, at the end of every day, they're going to be evaluated, and whether or not you want to sell them off every day, or sell them off or keep them, whatnot, you have a premium and a discount. And what this is in different countries, because of currency being evaluated differently compared to each other, you'll have a premium or a discount added onto your value. And lastly, the two other investment that we would say that you should go into are ADRs and ETFs. And ADR is an American Depository Receipt. And what this is this is foreign shares held in a U.S. depository bank, but it's traded on the U.S. exchange. So it would be like if a bank goes and buys outside stocks in a different country, brings them together, puts them into a grouping and sells them on a foreign exchange floor. And what this does is it hedges your portfolio risk because, again, those stocks are under the policies, under the fundamental news of the outside country, not of the domestic country, USA. And ETFs, the exchange traded funds, we can also use those to portfolio and decrease, or to diversify our portfolio, decrease our risk, because you can buy ETFs that are targeted into separate countries, segments. For example, earlier we were talking about the manufacturing of China or the agriculture of Japan, and what you can do is buy ETFs and focusing on just those indices and diversify your portfolio by getting into those markets without having to directly be in the market itself.
And next we have international diversification with hedge funds. Hedge funds are different from mutual funds because hedge funds can adopt flexible, dynamic trading strategies while using aggressive leverages, short positions, and derivative contracts. Hedge funds look for project profits no matter what the market conditions, whether it's rising or falling. Hedge funds can diversify your portfolio risk, and investors must be aware of the risk they are taking with a hedge fund with possible wrong predictions of the market. Next we have wide home bias in portfolio holdings, and countries seem to be more biased and prefer to invest in domestic equities. For example, the U.S. has 86% invested in domestic mutual funds, and then Brazil actually has 100% invested in domestic mutual funds due to regulatory restrictions, and then Germany was an example of one that actually invests in international domestic equities. And then three reasons for home bias in portfolio holdings is the possibility that investors face country-specific inflation risk due to the violations in purchasing power parity, and domestic equities may provide hedging against domestic inflation risk. The next is home bias may reflect institutional and legal restrictions on foreign investments. And the last is the extra taxes involved in the foreign investments. Lastly, we have the international diversification with small cap stocks. Usually well-known large cap stocks receive the dominant share of fund allocation. This is known as the large cap bias, similar to the home bias in portfolio. And small cap firms are likely to be locally oriented with limited international exposures. And return on small cap funds are primarily driven by local factors, and this is useful for portfolio diversification. And they often have a higher mean of return. And investors can enhance the gains from international investments by augmenting their portfolios with foreign small cap stocks. And lastly, we have our recommendation again. We will make $600 million in active management fees of a $30 billion portfolio fund, and then $2.4 billion in performance fees. That's it for the, thank you.
Can you go to the first slide?
This one or this one?
We'll start from the beginning. Okay, so that looks good. Next slide. Okay, now, how big is the fund? 30 billion. Okay, and you're going to make 2% on that, right? Which is 600. And then, what was your expected return on the portfolio?
We said 8% over 2-3 years.
Okay, and then what's the benchmark return? What's the alpha on the portfolio? Okay, you figure out the alpha, okay, and then you multiply the 15% of the performance, because you're getting paid for outperformance.
Yeah.
So it's going to be 15% of the alpha, right? Multiplied by the fund.
Yeah.
Okay, so I think you're off on the performance fees.
Yeah, on the performance fees, okay.
So next one. Okay, I would reformat that slide, like the other ones. And then what I would do off to the right of this slide, I would have a table showing the optimal portfolio allocation.
Yeah.
Yeah, show me the weights.
Yeah.
Okay, and then rank them so I can see it. Okay. And then I would center that and get rid of the, do some formatting on that too. But you don't show the Sharpe ratio or the return to risk ratios.
Yeah, okay, I can put those in.
Yeah, you definitely want to do that.
Explain.
And then here I would do international bond investment strategy. I'd add strategy to it. Okay, because again, what we're doing is we're making a presentation to some institutional clients with this presentation,
Yeah.
or internally. Okay, next. And then I would say GTC international mutual funds, because we can do branded mutual funds.
Yeah.
Okay, next. International diversification strategy. Okay. International diversification. Because these are the investments,
Yeah.
right? So what we can do is we can actually make money by underwriting those ADRs, because we have an investment banking division. We can also do GTC branded exchange traded funds. And we could recommend to our clients, they could either buy our funds, or what we'll do is we'll select other funds outside of ours to alleviate any conflicts of interest and make recommendations on which ones they should use, and we could build the portfolio for them, the ETF portfolio. So we could do that too. Then international diversification, and then I would do a colon and just say hedge funds, GTC hedge funds, because we have multiple hedge funds that we have. And what we can do is we can charge our clients fees as consultants to select other hedge funds on their behalf and do the research for them. So we could do that too. And then what I would do is just get rid of the Y, and I would just say home bias in portfolio holdings. So basically we're disclosing to our clients that there's an inherent bias here. Okay, so we're disclosing. And then I would do international diversification, colon, take out the with and just say small cap stocks. Okay. and then the GT, you know what to do on the GTC recommendation,
Definitely.
okay?
Alright,
So that's what I would do,
yeah,
to make it a little bit more powerful,
yeah, appreciate it.
okay? You're welcome. And then I recorded the comments so that you can
Okay,
go back
sounds
and
good.
look at them.